Hi, welcome back. All right, so in this video, we're going to be looking at this effects on net operating income of changes in variable costs, fixed costs. We're going to make changes in things and see how different changes or various changes will make changes in the overall outcome. We're also going to be looking at break even at the end of this video. So let's get started. So here we're going to look at a change in fixed cost and sales volume. So what's the profit impact if RBC can increase unit sales from 500 to 540, so we're increasing sales by 40 units, and we're increasing monthly advertising by $10,000. Well, that means a fixed expense of 10 grand. So what do we got? We have an extra 40 units, so 40 times 500 gives us another $20,000. So sales are now 270. Obviously, that's going to kick up variable expenses to 162, leaving us a contribution margin of $108,000. Now, we increased advertising by 10 grand, so our fixed expenses are now going from 80 to 90, leaving us an $18,000 net operating income. Do we like that? Not really, because we had $20,000 here. Now, we could have figured this out another way. We know that we have a contribution margin per unit of 200 bucks, right? So 200 times 40 is $8,000. If we're going to increase our sales by 8,000 or our contribution margin by 8, but we're increasing fixed expenses by 10, that obviously makes no sense. And that's what we're going to see here. Take that unit contribution margin times the additional number of units, and then compare it to the additional expense. Not a good idea. What is the profit impact if RBC can use higher quality raw materials, thus increasing variable costs per unit by 10 bucks to generate an increase in unit sales from 500 to 580? Now this is a little different, isn't it? Because we're not increasing fixed costs, we're increasing variable cost by 10 bucks. So increasing sales, hang on, let's go back and look at that again. From 500 to 580, so that's an increase of $40,000 in sales. Now we're increasing variable cost by 10 bucks. So now it's not 300 per unit, it's 310. So 310 times 580 gives us 179,008, leaving us a contribution margin of 110.2. We still have the same fixed expenses of 80, so we've increased net operating income by 50%, from 20,000 to 30,002, actually more than 50%. So what happened here that didn't happen before? This. Fixed expenses stayed the same. Since the variable expenses are based on the number of units produced, the increased expense is covered by the units. Number 3, what is the profit impact? Now we're getting 3 pieces. Number 1, cuts its selling price by 20 bucks per unit. 2, increases its advertising budget by 15,000 per month. And 3, increases sales from 500 to 650 units per month. So we're cutting selling price, increasing sales by 150 units, and increasing fixed expenses again by 15 grand. So 650 units, we're dropping the price from the unit cost from 500 to 480. So the price goes to 480 bucks. 650 times 480 gives us $312,000 in sales. Variable expenses obviously are going to be 650 times 300, leaving us a contribution margin of 117,000. We're increasing fixed expenses by 15, leaving us a net operating income of 22,000. So this whole package has increased our net operating income by $2,000. Number 4, pays a $15 sales commission per bike sold instead of paying salespersons flat salaries that currently total $6,000 a month, and increases unit sales from 500 to 575 bikes. Well, the second part is easy. We're assuming we're going to have an increase in sales of 75 bikes. But what's happening here in number 1? Well, we're eliminating salaries. Salaries are a fixed expense. So we're replacing the fixed expense of $6,000 a month with a variable expense of a sales commission at 15 bucks. So let's see what happens there. We've got sales. Again, it's going to be 575 times 500. Variable expenses, are now 315 because we're adding that commission. So our variable expenses are 181, 125, leaving us this as a contribution margin. However, we reduced our fixed expenses by eliminating $6,000 in salaries. So fixed expenses go down to 74. Net operating income is 32,375. So we've done a serious increase in net operating income. However, as I always tell my classes, remember what this does. The assumption here, and this is more from an operational rather than an accounting perspective, the assumption here is that your salespeople are willing to get rid of their salary and go straight commission. And that's sometimes hard to do. Good salespeople will always want to be straight commission because the commission is usually higher and they control their income. Good salespeople know that when you let them go, they're going to sell the hell out of whatever you got, because that's what they are. They sell. That's their business. So giving them a straight commission says go sell as much as you can, and they'll do it. All right, number 5. If RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, what price would it quote to the wholesaler if it wants to increase monthly profits by $3,000? Well, let's think about what's going on here. We have an opportunity to sell 150 bikes, a big chunk, right? It's not going to disturb the current sales, and it's not going to add to our fixed expenses. That's a key here, because if it's not going to add to our fixed expenses, we're going to assume that those expenses are already covered. So what is our additional expense when we sell another bike? Well, it's going to be the variable cost per bike. So we have a variable cost per bike of 300 bucks. We're going to take that $3,000 profit, divide it by the number of bikes we're selling, 150. So that means 20 bucks a bike, which means that our selling price, in order to get that $3,000, is going to be $320 a bike. Now, remember, this is a one-time deal. We're not going to do this on a regular basis because there's no fixed expense being covered here. Right? So we're not talking about contribution margin and fixed expenses and such. This is a one-time deal. So now we're going to look at determining break even. Remember, we talked about break even before, and break even simply means paying the bills. The equation and formula methods can be used to determine the unit sales and dollar sales needed to achieve a target profit of 0. Now remember, most companies are not going to be looking for a target profit of 0, right? Every company wants to make a profit. What will happen, though, is something that I did for the managing principal of the architectural firm I worked for 10 years. I would give him a break-even number on a project. I'd take the budget and work out what the break-even was. Because when he went in to negotiate with the client what our fee was going to be, he needed to know how low he could go. And beyond which, he either had to say, I'm sorry, we can't do it for that price, or, okay, fine, assuming that we're going to get another bigger project down the road where we'll make a bigger profit and we can make up for the loss. So we've got the same basic information as before. And the equation method relies on the basic profit equation, right? So we've got profit equals unit contribution margin times quantity minus fixed expenses. We've been working with that for a while now. Now, with break-even analysis, the profit is going to be zero, meaning there's no profit, there's no loss. We pay the bills. In our case, for RBC, the unit contribution margin is 200 bucks. So in a single product situation, the equation method is this. So 0 equals 200 bucks times the quantity sold minus the $80,000 fixed expenses we've got. We're going to work through the numbers here, right? We want to isolate the Q because that's what we're looking for, the number we need to sell. And the break-even number for RBC is 400 units. And we knew that from calculations way before in the last discussion. The formula method is a shortcut version of the equation method. So a lot of students like the formula method because it's a little easier to work with. We take fixed expenses and divide them by the unit contribution margin. I'm going to point out here, you need to remember, unit contribution margin is used to find the units. The contribution margin ratio is used to find break-even in dollars, dollar sales. So we've got $80,000 in fixed expenses for RBC. We have a $200 unit contribution margin, meaning, again, 400 units for break-even. Suppose RBC wants to compute the sales dollars required to break even. So now we're going to use both the equation method and the formula methods to do that. So again, with the equation method is profit equals contribution margin ratio. Remember, ratio is used for dollar break even. The contribution margin is used for the units. So we've got contribution margin ratio times sales minus fixed expenses. In the case of RBC, it's going to be a contribution margin ratio of 40% times some kind of sales minus the $80,000 fixed expenses. So again, we need to isolate what we don't know. We're isolating sales. So we're moving the 40% times sales over to the left because there's 0 here, so we can pop it over. We're going to isolate sales by dividing this by 40% and dividing this by 40%. And the sales the break even in sales is $200,000. Using the formula method, it's fixed expenses divided by the contribution margin ratio. So 80,000 divided by 40% is 200,000. And if you remember, we calculated 400 bicycles as break even. Well, we have a price per bike of 500 bucks. If 400 bikes is break even, 400 times 500 is 200,000. So what we're looking at here is what we looked at in the last video as well. We're looking at these things from a variety of perspectives. And that's going to end us for lecture number 2. I will have lecture number 3 shortly, so I'll see you there.